Hello and welcome to the virtual classroom where today we'll be discussing the accounting cycle, specifically the first two steps of the accounting cycle. So we learned previously that accounting is a system that identifies, records, and communicates information in a way so that it is useful or relevant, reliable, and comparable. All along that system, there are steps that we need to take to ensure that the information that goes into the system is useful to our external users. And we're going to look at the first two steps of that entire system or cycle. The first one is analyzing source documents. Our source documents are pieces of paper or electronic files that contain all the information about our transactions. So when we analyze our source documents, we're looking at things like invoices, checks, time tickets or time sheets, and we're gathering information about our transactions. We're checking to see whether or not we earn money, or did we spend money? Did we pay our employees? Did we purchase goods? All of that information can be found on our source documents. If we're talking about the classroom, then the textbook or the exam question is our source document. But in the real world, we're looking at those pieces of paper and those electronic files that serve as records for our transactions. In the second step, we begin the journalizing process. Journal entries are the formal way that we record all of our transactions. And in accounting, we use a system called double entry accounting. Double entry accounting uses debits and credits. What you see on the slide here is an example of a T account. A T account is an account that is used to help us keep track of what's going on within our specific asset, liability, and equity items. So when we look at a T account, every account has a debit side and a credit side. Debits are on the left and credits are on the right. Debit doesn't always mean add and credit doesn't always mean subtract. Debit doesn't always mean good and credit doesn't always mean bad. It simply depends on how we're using this account and what type of account we are dealing with. Now, T accounts can be used in the analyzing process, but T accounts can also be used in the posting process, and we'll talk about that in another video. But for now, in accounting, we don't say an account has a positive or an account has a negative, or even when we're formally recording transactions, we don't say an account increased or an account decreased. We use the term debit or credit. Now, whether or not we use a debit or credit to increase or decrease, that depends upon the normal balance of the account. So some accounts will have a normal debit balance, which means we use a debit to increase that account. And some accounts will have a normal credit balance. That means we will use a credit to increase that account. So let's take a look at the accounting equation. And we learned about the accounting equation in a previous video as well. Assets equal liabilities plus equity. Every individual asset, liability, or equity account will have an individual T account. But just for a second, if we were to take the entire accounting equation and put it on top of a T account, then let's look at what happens. Notice what happens. Everything that falls on the left side of the T account has what's known as a normal debit balance. Or in other words, all assets will use a debit to increase that item and a credit to decrease that item. All liabilities and equity, if you're looking at the accounting equation, they fall on the right side of the accounting equation or the right side of the T account, and these items will have a normal credit balance. After analyzing each transaction, debits must equal credits. The same way, assets have to equal liabilities plus equity after analyzing each transaction. So I'll take this moment to say everything that you know about debits and credits from the banking world, from the real world, I need you to forget. I'll reconcile it in a second, but right now, if you bring that in, it's going to be reversed. It's going to be confusing. Right now, I just need you to understand that assets have a normal debit balance because they fall on the left side of the accounting equation. That means we use a debit to increase all assets and a credit to decrease all assets. Liabilities and equity have a normal credit balance. Why? Because they fall on the right side of the accounting equation or the right side of the T account. That means we're going to use a credit to increase these items and a debit to decrease these items. Now let's dive in a little more closely here with looking at assets. We have some examples of assets listed here. So again, every account has its own T account, and we can keep track of what's going on in that account by looking at our individual T accounts. But because all of these are assets, we use a debit to increase, a credit to decrease. Assets have a normal debit balance. Now let's jump to the other side of the accounting equation, and let's look at our liabilities. Liabilities have normal credit balances. That means we use a credit to increase and a debit to decrease. So remember, liabilities are items that we owe. So notes payable, accounts payable, wages payable, all of those are classified as liabilities. Now for equity, we have 4 equity items, specifically capital, revenue, expenses, and withdrawals. There are 2 equity items that have a decreasing effect on equity, and those are expenses and withdrawals. Because of this, even though my equity items fall on the right side of the accounting equation, not all of them have normal credit balances. Only capital and revenue have normal credit balances. Withdrawals and expenses have normal debit balances, and that is because those items have a decreasing effect on equity. So we get that opposite imaging going on here, and those items will have normal debit balances, meaning we use a debit to increase those items and a credit to decrease those items. So just to recap, I can group together assets, expenses, and withdrawals. These items all have a normal debit balance. And then we can group together liabilities, capital, and revenues. All of these items have normal credit balances. We use a credit to increase and a debit to decrease. Now, this whole process, eventually you're going to be doing this in your head because this is not the formal way to record our transactions. Yes, we have the T accounts to help us, but this, again, is not the formal way we record our transactions. Here, we get to see the formal way we record our transactions through the use of journal entries. After we determine which account is being debited and which account is being credited within our transaction, then we can formally record our transaction. So here we have 3 journal entries listed here. Every journal entry has a date, so make sure you list the date first. The next item that is listed is the account that is debited, and this is very important. It's not always assets. It's not always cash, but it is always the account that is being debited. So list that account first, along with its amount. Now, the next item is the account that is credited, and it should be indented. So move that over so it's not directly under the account that is debited. If it's directly under the first account that's listed here, then someone is going to assume that you were trying to debit cash instead of crediting cash. So make sure you indent the account that is credited. Along with that, the number should be moved over into the other column. So it should not be directly under the debited amount. It should be in a separate column. And the last piece is the description or the explanation. I say all the time, there's not a lot of room for creativity when it comes to accounting. And this is because if you get too creative, you're going to prison. So this is the only place where you get to be creative, where you summarize the transaction in your own words. Now, these numbers listed here, I skipped over those because these are the account numbers for these individual accounts listed here. Every company will have a chart of accounts, and that is a listing of all the accounts that the company uses in all of its transactions. Assets usually begin with 1, liabilities typically begin with 2, and then you'll have capital and withdrawals starting with 3, revenues 4, and expenses 5. But We'll talk about why those account numbers are here later when we look at the posting process. Now, if you'd like to see a few examples where I walk you through how to go through that analyzing and recording process in terms of determining what should be debited and what should be credited, join me for the next video. I'll do 5 examples and we'll prepare some journal entries. I thank you guys so much for taking the time to watch this video. Take the time to post your questions in the comments and I'll get back with you as soon as I can. I hope you have a wonderful day.